Welcome to My Steel Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global commodity markets. I'm Nikki Fu, Commercial Director at My Steel Global. From July 17th to 23rd, China's LPG markets stayed firm, with the domestic prices moving higher even as refinery output recovered and import arrivals increased. That tells us this week was not just about supply, but also about how the market was reacting to international pricing, downstream buying, and inventory flows. So, what exactly was driving the strength? Joining us today is Aibo, Lead LPG Analyst at MySteel Oilchem. Aibo, welcome back.
Thanks, Nikki. Great to be here.
Let's start with the main takeaway. China's LPG market strengthened again this week, even as supply continued to build. What was behind that?
The key driver was the combination of firmer international pricing and active downstream replenishment. Globally, ongoing geopolitical tensions and tighter supply expectations kept crude oil prices on an upward trend this week, with international LPG benchmarks following higher. At the same time, China's domestic buyers were not waiting for the market to settle. Many downstream participants moved to secure cargoes earlier, especially after seeing international LPG prices climb. So even as supply recovered, prices remained elevated, supported by buying interest and rising import costs.
So this was not a simple supply story.
Exactly. Bullish sentiment encouraged downstream buying, with most regions reporting smooth sales. That helped keep China's LPG prices elevated.
Let's take a closer look at the supply side. Refinery production remained stable, while import arrivals rose sharply. Why didn't the additional supply drag prices down?
Refinery maintenance was winding down, while import arrivals surged again, but higher crude oil prices and solid demand continued to underpin the market, allowing China's LPG prices to move higher. In other words, the market did not react to supply in a linear way. Although supply grew faster than demand this week, the market's reaction was shaped more by expectations than by the supply increase itself.
That sounds like the market was more concerned with timing than with absolute availability.
That's right. The market was not short of supply in a structural sense. The issue was that many participants were buying ahead of further price increases, so the additional supply did not immediately translate into lower prices.
And was the demand side really stronger, or was this mostly replenishment?
Let's break it down. Overall petrochemical demand improved this week, while propane consumption from the PDH sector edged lower as operating rates slipped slightly. Stronger demand from butane-based chemicals and olefin C4 producers lifted overall consumption. But residential fuel demand stayed weak, and little improvement is expected in the coming week. So the strength this week was not completely driven by broad-based demand growth. Instead, it was supported by stronger chemical demand and bullish buying interest. Over the coming week, refinery supply and import arrivals are both expected to decline, while petrochemical demand is expected to improve. The market is still expected to remain in surplus, but the surplus should narrow.
So buying sentiment clearly played an important role this week.
Exactly. It also means we'll need to watch whether buying interest can be sustained. With supply continuing to outpace demand, any weakening in sentiment could put downward pressure on prices.
That brings us to the downstream picture. PDH margins improved, while alkylation margins weakened further. What does that tell us?
It tells us that LPG demand is not being supported evenly across the downstream chain. PDH economics improved this week. Propylene prices remained elevated, while propane feedstock costs stayed relatively low. The wider spread between the two prices helped expand PDH margins, providing stronger support for propane demand. Alkylation moved in the opposite direction. Although stronger crude prices provided some support to the broader market, tight C4 supply pushed feedstock costs higher as alkylation plants competed for limited supply. As a result, higher feedstock costs continue to weigh on alkylation margins.
I see. Inventory trends also told an interesting story. Producer inventories fell while port inventories rose. How should we interpret that?
Producer inventories moved lower this week as downstream buying remained active, with most regions seeing inventory declines. However, port inventories increased sharply due to higher import arrivals, especially with strong cargo inflows into East China. We could say that the inventory levels moved in different directions across the supply chain. In the coming week, China's domestic supplier inventories are expected to increase slightly as prices remain at high levels and downstream buyers become more cautious. Port inventories are also likely to edge higher as import arrivals remain relatively high despite some decline in incoming cargoes.
So the market is not moving in one direction. Inventory trends are diverging across the supply chain.
You're right, producer inventories declined as downstream buying remained active, but stronger import flows pushed port stocks higher. That means the market is still absorbing incoming cargoes, and the key question is whether demand can keep pace with supply growth.
And what should international participants watch in China's LPG market next week?
Next week, the market is expected to remain supported, but the pace of gains may slow. Supply is likely to tighten as refinery output and import arrivals decline, while petrochemical demand is expected to improve. Although the supply-demand gap is expected to narrow, the market will likely remain in a surplus position. Geopolitical developments will continue to influence market sentiment. Higher crude oil prices and stronger international LPG markets could continue to support China's domestic market. However, with prices already at relatively high levels and fuel demand remaining weak, further upside may become more limited. In summary, China's LPG market is expected to stay firm next week, with prices likely to rise by around 50 to 100 yuan per ton.
Thank you, Ibo, for sharing your insights. This week demonstrated that improving supply did not necessarily translate into weaker prices, as rising crude prices encouraged further buying and downstream participants replenished inventories against the risk of potential supply disruptions. Going forward, the market will depend on whether downstream demand, particularly from the chemical sector, can keep pace with incoming imports. Ibo, thank you again for joining us, and thank you to all our listeners. If you'd like to follow these developments in more detail, the full analysis and data behind today's discussion are available through MySteel Oilchem's latest China LPG market weekly report. For more information, please visit mysteel.net or contact us at inquiries@mysteel.com. Thanks for listening to MySteel Commodity Flux. If you found today's episode helpful, be sure to subscribe for more analysis on global commodity markets. Until next time, keep tracking the flows.